The economy looks calm, jobs are strong, companies are reporting profits. Everyone says things are fine, and then, in a few days, the stock market drops 10%. People stare at their screens and ask the same question every time. How did this happen? Nothing was wrong. That confusion is the point, because stock markets don't crash when the economy is weak. They crash when the story breaks. Right now, this matters more than most people realize, because we live in a world where markets react faster than reality, and the gap between how the economy feels and how markets are priced has never been wider. So let's slow this down. No jargon, no charts that lie, just how the system actually works. First, we need to kill a myth. The stock market is not the economy. The economy is people working, spending, producing, and earning over time. The stock market is a place where investors bet on what they think will happen next. Not today, not last quarter, next year, sometimes 5 years from now. That single difference explains almost everything. When you hear the economy is doing great, that usually means things look okay right now. But markets don't trade on now. They trade on expectations, and expectations can quietly rot while everything still looks fine on the surface. Here's how that happens. Imagine a company. Sales are growing, profits look solid, the news is positive, so investors buy the stock. But they don't just buy based on profits, they buy based on future growth. How fast will profits grow? For how long? At what risk? That future gets turned into numbers, very specific numbers. If a company is expected to grow fast, investors are willing to pay a high price today. If growth slows, that price suddenly makes less sense. And here's the uncomfortable part. Markets don't fall because things get bad. They fall because things get less good than expected. A company can be profitable and still see its stock crash. A country can be growing and still see markets collapse, because the price already assumed perfection. This is where the math quietly turns against everyone. Let's talk about interest rates. Not in theory. In reality, interest rates are the price of time. When rates are low, the future looks valuable. Money 5 years from now still matters. When rates rise, the future gets discounted hard. Suddenly, profits expected years from now are worth much less today. Nothing has to break, nothing has to fail. The math just changes. And when the math changes, prices adjust fast. This is why stocks can fall even when earnings are strong. The cash is still coming. It's just not worth what investors thought it was worth. Now add leverage. Leverage is borrowed money used to invest. In good times, leverage feels invisible. It makes gains look smooth and effortless. But leverage has a rule. When prices fall, debt doesn't. So when stocks drop, leveraged investors are forced to sell. Not because they want to, because they have to. That selling pushes prices down further, which triggers more forced selling. This is how calm markets turn violent without warning. No recession required. And then there's liquidity, the most boring word that explains the most chaos. Liquidity is how easily money moves through the system. When liquidity is abundant, small problems stay small. When liquidity dries up, tiny shocks become disasters. Central banks control liquidity indirectly, through rates, through signals, through confidence. Sometimes all they do is talk, and markets listen. A single sentence from a central banker can erase trillions in market value. Not because the economy changed, but because expectations did. This is the part no one likes to admit. Markets are emotional systems wearing mathematical masks. They move on fear, relief, greed, and relief turning into fear again. Hype builds quietly, valuations stretch, risk gets normalized. Then something small happens. A missed forecast, a policy hint, a number that's fine, but not great. And suddenly, everyone realizes the same thing at once. We were all assuming too much. That moment is the crash, not an explosion, a collective realization. History is full of these moments. Before 2000, the economy wasn't broken. Technology was real, growth was real, but expectations were absurd. Before 2008, people had jobs, homes were being built, money was flowing. The system didn't collapse because people stopped working. It collapsed because the math stopped working. Assets were priced for a future that could never exist, and when that future disappeared, prices had to catch up, fast. This is why markets often crash before recessions start. They see the turn coming before it shows up in jobs and GDP.
And sometimes they crash even when no recession comes at all. Because prices don't care if the economy is fine. They care if reality matches the story. Right now, that story is under pressure. Debt levels are high. Rates are no longer near zero. Growth expectations are fragile. None of this means disaster is guaranteed, but it does mean markets are less forgiving. In a system built on future promises, small changes in assumptions matter more than big changes in reality. That's the uncomfortable truth. The stock market isn't a scorecard of how well things are going. It's a nervous system reacting to what might happen next, which leads to the real question. If markets can fall while everything looks fine, how would you even know when risk is truly building? And more importantly, would you recognize it before everyone else does?